So good morning everyone and welcome to this live training. The question I get asked pretty much nearly on a daily basis is, should I be buying in a limited company or in my sole name? But before we get into that, if you're new to this channel, make sure you stroke that like and subscribe button. Really helps out the algorithms and you'll get notified with more content like this and other videos all around property investing mindset. So today in this training, we're going to dig into which could be possibly the best way for you to purchase property. But before we get into that, I'm going to put out a little disclaimer. I'm not a tax advisor. I'm not a financial advisor. This is not tax advice or financial advice. I'm just sharing you my experience from the many books I've read, many network events, and been around accountants and growing a portfolio myself, which is into a group structure. So I'm just sharing my experiences. Always go off and do your personal due diligence. So I'm Harvey, I'm a remote property investor. That means I live in the south, but I invest in the north, east. But property changed. I think it was, what year was it come out? George Osborne anyway, and the Labour government changed the surface and the fabric of property investing. I think it was around 2014 when they announced this, and it's been phased out, and last year was the last year of the dreaded Section 24. So I'll get into, this is why there is a debate over this. So past years, what people used to do is they used to just buy in their sole name and just get up to a point where the lenders wouldn't lend them anymore because they'd only lend you so much, had so much appetite to you as a sole trader. They'd lend you up to that point of appetite and you start buying a limited company because you exhausted your avenues of lending. And then you go into a limited company and start buying that way. And the reason behind it is because the rates are cheaper in as its sole name. At the moment, they got really, just before COVID, the rates really got competitive and really close between limited company and sole name. And they're spread apart again now. In your sole name, you can get rates under 1% at the moment. In a limited company, late twos. So you can see how far apart that, it's about 1.5% at the moment. At one point, it got about 0.5% as a squash, as competitive. Now it's really drifted back apart again. The other thing as a sole name, what was more attractive was the fact that you had less legal costs and it was less friction. So I'll go into more details about the pros and the cons, and I'll figure out for me there's quite a simplistic way to figure out whether you should be limited or sole trader, but ultimately there's loads that goes with this and you need to get that advice. So what I would suggest you to do, if you're toying with what to do on this, write down some notes, take some pointers what I've took today, then go and seek yourself out a specialist accountant, a specialist in property that you can talk to. I have actually got a free ebook, how to qualify and disqualify a specialist accountant for a property that's suitable for you, because you might find a specialist accountant and he's too high level for you and you'll pay him hundreds of pounds when you've only got one property. So a massive question I get asked all the time: limited company or sole trader? So the main reason this is a question now is because of George Osborne and the Labour government come in with the thing called Section 24. This is a tax. This is an anti-landlord tax, some people call this. But basically how Section 24 works is, let's get a pen, that's a little bit of a thicker marker here. How Section 24 works was, before Section 24, in your sole name, let's say you had a property down here that paid you £1,000 in rent. Let's say just for round numbers, these are not exact numbers, they're not based on anything, it's just to make the example easy and the principle behind it. Let's say you had £500, say your rent was £500, your mortgage was £500 and your costs was £200. So this is like voids, maintenance, management fees, blah, blah, blah. Then at the end, what you was left with previously was a £300 profit. So how it worked like before Section 24. So now Section 24 is if you had this on an interest only mortgage, this element, I put here rent, this should be mortgage. Apologies guys, let's quickly give that a little rub out so we don't confuse anybody. This is your mortgage. So how this previously worked was this element here used to be able to be offset against your tax as a running cost. So this is why people have done interest only mortgage and not repayment mortgages. So with an interest in business, interest that you accrue within a business is a running cost of your business. So it's offsettable against your tax. You can do that in any business in the UK apart from property in your own personal name, which is absolutely strange. Lots of people are challenging this because it's unfair taxation, because you're meant to tax everybody fairly and equally, and they're not. They're just targeting landlords in your own personal name. So before, you would have this would have here, your £300, let's get a few different colours here. Your £300 a month would have earned you 3,600 per year. So if you look where the tax would have been off of that, you would have basically paid £720 tax off the back of this, and that would have left you with a £2,880 profit, which is pretty decent, you know. So then with section 24, after section 24 come in, let's see if I can find a different colour here to example this, find a pen that works. So after section 24 come in, the government stepped in and done their thing. At the moment now, if you take this same property that gives you £1,000, and then your mortgage is the same again, £500. If you're a high rate taxpayer in the 40% bracket, you can no longer offset this element. So this part of it is going to get dragged into what you pay tax on. So before, you only pay tax on this part here, which was left. So now let's say there's £200. Let's say there is £200. What's the name? You're going to have £700. You're going to get taxed on you've got £200 costs, which you can still offset. So you're going to be taxed on the £700 per month, not minus this part. So you can see already how this could get you into a little bit of trouble. So what's that over a year? 7,000, 8,000. 8,400. So your tax bill, you're going to pay, and you're going to be a high rate taxpayer. So you're going to pay 40% against 8,400. My maths is not that quick today. I should have wrote it down beforehand. But you can see already straight away, this could potentially completely wipe that profit out. If you pay 40% of that, so what's that? 4, 8, 16. Yeah, I can't work that out this morning, sorry guys. But you can see 40% of that's nearly half of that is going to wipe that profit out pretty much. So some people are facing a position where their properties was earning money, they're now not earning money. But that said, this is only if you are a high rate taxpayer. So if you earn above 50k per year, roughly, it's not exact, mate. Yeah, exact, man. So if you earn above 50k per year, this is going to destroy you like this. If you don't earn above 50k per year, you get a 20% tax credit against it, which theoretically brings you back to here. So this is what you've got to ask yourself. So you've got to look at your personal income, what you're on at the moment. You've got to see where you are in your journey, what your end goal is. Age comes into this. So, and what you want from your property vehicle. Because, let's say, for example, I've seen couples, like, do you want a boutique property investment vehicle, or do you want to build a big empire? Because if you want to build a big empire, you're definitely going to be over here. Because what happens is, so I've got 14 properties still in my sole name, and we're going to incorporate them. I think I've got about a year left with the partnership I formed with my wife, which we can get incorporation relief beyond the level of this video here. Just another quick reminder, if you're enjoying this, please give this a like, smash the subscribe button. It really helps the algorithms with this, push it out there and give me an understanding knowing that you are liking this, and I'll make more content like this. But we're going to move these into a limited company, because at the moment, I don't take any of my profits from any of my businesses. I'll just compound that back into my businesses. Growing my business, growing the systems, building my teams, buying more properties, buying more assets, buying more digital assets, buying some other assets, gold, cryptos, stocks. So I compound all my earnings in, and I'm happy to live like quite frugally under that 50k bracket, but I'm not always going to want to live like that. I've got a plan and a vision, and I'm building and I'm compounding, but it's going to be a point where I'm going to want to take more. Because when this tax first come out, I initially thought to myself, do you know what I would do is I will shift a few of my properties, sell them to my company, just pay the stamp duty on it. I didn't have to pay any capital gains tax because the gain that was on it wasn't more than 12k. They used properties in the north, so I managed to swerve the capital gains tax and just pay the stamp duty, and got myself under that bracket, paying the 20%, paying that 20%, getting that 20% tax relief credit that I got, and I stayed okay. And I thought, oh, that's fine. But then I was like, oh, at one point I'm going to want more than 50k a year, so at that point, I'm going to get crucified. So I need to move them across. But a few of the pros and cons that you've got to really think about in a limited company, as I said, is don't forget, yes, in a limited company, as it stands at the moment, well, it stands like this at the moment, sorry, not as it stands at the moment. In a limited company, let's try and get a different colour down here. In a limited company, if you buy in a limited company, you don't get charged on your turnover, basically. You just get paid 19% tax. That's corporation tax on your profits. So you pay actually less than you do 1%, even if you're in that lower tax bracket. So in a limited company, what you've got to think about, what a lot of people don't think about, is that's in your company. That company is a limited liability of you. So it's not you. So to get that back into your pocket, so let's say your companies earn this money, this much per year. Now, yeah, you've paid, maybe you've earned a little bit more because of tax you pay, but that's inside your company, which is like a little box here. That is not you. You cannot access that. You might be able to use it for maybe paying some of your insurances and paying some of your fees. By the way, I just see a like go off there. If you're finding news from this, please smash away at that like. It really does help the algorithms out, push this message out there. But this limited company, this LTD, is a little box where you cannot access that money. You can buy, like I said, some expenses, maybe pay for your car and phone bills and blah, blah, blah. But you cannot access that to go on holidays, pay your normal mortgage, blah, blah, blah. And the minute you want to access this money, you've got to pay dividend tax, which is either 7.5% or 37.5%. So then straight away, especially if you get hit with this one and you've not got the right tax advisor, again, if you want how to qualify, disqualify tax advisor and find your tax advisor, stick in the comments free ebook and we'll get you out a book, what questions to ask the tax advisor, what you should be thinking about, what research you should do before going to get a tax advisor. We'll give you that ebook. But if you've got hit at 37%, you've paid 19 up here, and then to get it out, you've got to pay 37%. Or you might pay yourself a salary from the company, so you paid 19 here, and even if you're a low rate taxpayer, you pay yourself a salary again, you're going to be paying yourself 20% on income tax salary, or 40%, depending what tax bracket you're at. So you are paying tax here and then paying tax again to pull it out of your company. This is the thing a lot of people don't think about. What vehicle do you want your company for? Do you want to just build an empire and compound that money to build up, just to give as a legacy and keep on buying more property? Or do you need to live on it day to day? How much do you need to live on day to day? How much will you sell to live on day to day? How big are you realistically going to grow your property portfolio? Is it going to grow beyond there? You might be a husband and wife, for example, and you've both got that allowance, and you can get onto 100k a year, and you think, you know what, we've got 100k worth of income between the two of us, and we're just going to go traveling, we're going to get a manager to manage it. I don't want to build this massive company. So it goes back to knowing your why and what you're getting into property for, and what the reasons are. And I got this from Robert. I modelled this from Robert Kiyosaki, cash flow quadrant. And there's 4 different types of property investor. You've got your hands-free, you've got your part-time, you've got your solopreneur and entrepreneur investor. Hands-free is somebody get somebody to do it for them. They want a lifestyle, they're more a boutique style thing. Part-time is somebody who enjoys their work but just wants a little side hustle. Solopreneur is somebody full-time in that and runs the business all themselves. They've not really got teams and systems to run without them. An entrepreneur is somebody it can run with or without. If you want to get to this status down here, you definitely need to be going through a limited company. But that said, that status takes a lot of time and effort and ups and downs and some crossing. Daniel Priestley calls it crossing the desert to get there. So if you just want a bit of a boutique style business out of it and you think you're definitely stay under 50k, then it's probably not it might be a sole trader. As I said, all the costs in a limited company, even down to arrangement fees with lenders. You can buy the same property either in your sole name or in a limited company with the same lender, and they will charge you more money for the valuation, more money for the arrangement fees, your year-end tax is more money. Easily, somebody might correct me on this, but I believe it's way over 1%, more like 1.5% more on your rates at the moment. So there is cons around having it in a limited company, especially if you need to live off that money and you want that money accesses to you. But if you've got another income on the side, or you've got another business, or you're making multiple streams of property income. So for me, I've got a training company. If you've got other companies, so I'll be taking my income from one of my other companies, not from my property portfolio. My property portfolio is going to be wealth building, so the income from that. At the moment, my income comes from the properties owned in my sole name. But as I said, I'm going to want to hit above that 50k barrier very, very soon. I'm bordering it now. So yeah, you can only live, like, it's all well and good compounding and building for the future, but you've got to enjoy it as well. And obviously I've got kids now. I've got another kid coming, one kid here. Life becomes more expensive when you've got kids. If anybody's got kids, they'll understand that. But basically, the simplistic way to figure it out is, do I believe I want 50k in my pocket more each year from my property portfolio? And do I believe that I'm going to grow a sustainable amount more than that? Because if the answer is no, and you're happy to retire off that 50k a year, or give up your job or that 50k a year, it's probably a sole trader. I say probably, but if not, limited company is going to be the way forward for you. So remember, if you don't evolve your ideas, you never live on your own terms. Please join me this Thursday, bit.ly/invest remotely. If somebody could put that in the comments. I'm just going to shut Facebook down. I should have said it earlier on. I'm doing a how to invest in BRR property remotely and live on your terms. I'm doing a deep dive online training, like a webinar form with slides, loads of value on there. So join me this Thursday. Register bit.ly/invest remotely. And have a fantastic day. If you want to see these Q&A on TikTok, jump across to my Harvey Growth Properties TikTok.